Bank of Canada drops interest rates again, and home sales are down, average prices are down, home ownership is down, or is it? All this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I'm great, Gary. How are you?
I am excellent. It's a sunny day in most of Canada, and there's some news coming out of Canada today, as we all know.
Yeah, so it's funny that our podcast happened to land on a Wednesday, and so today is the day that the Bank of Canada announced yet another rate drop, which was widely expected and thankfully followed through on. And so just in summary, from the peak it was in 23-24, the Bank of Canada has dropped rates from 5% to 3% on their overnight rates, which means that at the retail borrowing level, of course, it means it's cheaper for those buyers to borrow or just mortgage holders as well. I'm already getting a bunch of inquiries from people, Dion, is my rate dropping? When's it going to drop? And for anybody who's curious about that, if you have a variable rate, this will be effectively implemented today and will be reflected on your next statement. If you are in a variable rate with an adjustable payment, your payment will be lower on your next payment. But if you have a static payment, your payment will be the same on your next payment, but the proportion that goes to principal will be slightly higher, meaning you're paying down your home faster. So that's the impact on variable or adjustable rate holders. In terms of fixed rate holders, there's no change to your payment. You chose a fixed rate, which means that the variable rate changes don't directly impact your existing mortgage there.
Okay, there's lots to unpack there with getting diving deeper into some of those questions. I'd love to spend just a moment or two, from your perspective, why do rates change, every quarter, or sometimes not? We get rate freezes and all that kind of stuff. Help us out with that from an economic standpoint.
Yeah. So look, there are some big economic indicators that the Bank of Canada and the government watch very carefully. The big ones are GDP and unemployment. Okay, they're the big ones that they really want to keep their finger on the pulse of, and all of that also translates to inflation. Okay, so what's happened over the last several years is inflation went insane, so interest rates went up accordingly. When that happened, businesses stopped borrowing money because it was so damn expensive to borrow money. Therefore, expansion of business was limited or halted. When that happens, also in the economy, regular consumers don't have as much cash flow in their pockets to buy goods. So spending is down. And effectively, the desired outcome of these interest rate increases was suppressed GDP growth and suppressed inflation. All great. But now the pendulum swings the other way. And now we are at a point where unemployment is increasing because fewer people were buying fewer goods, okay? And employers are freezing and or laying off people. So now we have a different problem, the problem being unemployment. And so the way that interest rates play into that is, okay, if we drop interest rates, maybe it will give these businesses the incentive and the belief that, okay, tomorrow will be better than today. And it does make sense to, in fact, go and hire people and expand your business and employ more people. So this is kind of where the government is focused right now. It's like, okay, our plan worked, but now we have to deal with the consequence of that plan, which is unemployment. And so with inflation, with unemployment up, they are trying to stimulate that through decrease in interest rates. And, that's a knock-on effect to also a reduction in people's mortgage payments, which means also potentially an increase in consumer spending, which we're yet to see, frankly.
Yeah. And you touched on, there's less spending going on, and just to provide a little bit of clarity on that, we've talked about many times. You follow Dion and I for the last several years. You know that we've talked about this. It's very well documented that a sale in the Toronto or GTA area will generate approximately $64,000 back into the local economy.
How much of that is land transfer tax?
Well, that's not even including land transfer tax. So yeah, that's another story on itself. So that's
Sure.
$64,000 per sale. And as we all know, over the last couple of years, we've seen the number of sales on the Toronto Real Estate Board drop by significant percentages. And we went from 100, 115, 120,000 sales down to 65-ish thousand sales. So get this, my friends, do the quick math with me. 64,000 times even 1,000 homes is $64 million not being put into the local economy. So for
Oh
every
wow, and you
1,000 homes,
multiply that number by 30, and that would
30,
be the
yeah,
yeah.
40,000.
Okay.
That's now we're talking some big numbers, and you wonder to yourself, well, why, why did everything go up, inflation go up, and all that kind of stuff, and interest rates go up? But there's also a lot less being, we'll call it, being traded around, goods for services, and think about like home renovators and your local building
Yeah.
supply companies and all that kind of thing that goes along typically with buying a home. You buy a home, and the first thing you want to do is paint the walls and start redecorating. Well, that's not happening as fast as it used to.
Yeah. So anecdotally, one of my friends is a buyer for Home Depot, and she was saying that in the peak of 2020 2021, orders went absolutely insane, and now they over ordered and then had to store a bunch of this stuff in warehouses, and now they're discounting stuff, and they're not ordering because they're trying to empty their warehouses because they're full to the roofs, right? So that's a really interesting indicator. In fact, I haven't looked at the stock price of Home Depot, but that would be an interesting thing to look at. Maybe we'll pull it up on the next episode.
Yeah, that would be, and to even add to that, everyone, if for those of my friends that know me, I love mountain biking, and obviously a lot of those outdoor activities during, we'll call it, the COVID years skyrocketed, and there are many major bike and cycle manufacturers across the world that ramped up production, and now they're just sitting on inventory because that the same interest or the number of sales aren't there, and they're having to let people go based on the amount of product. And you could probably say that about a lot of different types of industry, a lot of product that was built or created and it's just sitting there on shelves at this moment. So if you're
And
looking for a mountain bike,
I think maybe also as it relates to that, people have a little less free time in that a lot of people are getting called back into the office. So they may not have time for those sort of recreational things, in addition to the lack of funds
yeah.
to go and enjoy those things, right?
Yeah. Yeah. Okay. You said let's dive a little bit deeper on what does that interest rate change look like today for a borrower, and you sent me a slide over, and let's go through that and provide some clarity of what's what people can expect, and of course what this means to a borrower.
Yeah. So what we've done here is giving you an example of a $700,000 mortgage. The reason I picked this number, Gary, and it's kind of crazy to say this, but 700,000 seems to be about the middle of the road number where our first time home buyers are borrowing funds at the moment. If you go back just 5 or 6 years, that number was probably half of this number, but 700,000 seems to be the number where people can actually get into the Toronto real estate market. Okay, so we've got a couple of columns here, but basically we're looking at 4 major categories, which is interest rates, amortization, the monthly payment, and then the income required to qualify for this $700,000 mortgage. So in that second column there, you see the heading 2023. So in 2023 and for most of 2024, interest rates were elevated, and a fixed rate was going at around 6.5%. Okay, it was very common at the time. If you were getting a high ratio insured mortgage, in terms of amortization, we were maxed out at 25 years amortization. And that translated to that monthly payment there of over $4,800 a month. And the income required to qualify for that $700,000 mortgage just a year to 2 years ago was $164,000. Okay. Now, if we jump over to the 2025 column, as of today, Interest rates right now are hovering at around 4.25%. So that's a reduction of 2.25% in just the last year or so. Okay, so affordability in terms of interest rates down a lot. Now, the next great thing that's happened just as of December last year is the amortization has also been increased from 25 years out to 30 years, so adding 5 more years. And the benefit of that is it results in a smaller payment. Now, that payment, whereas it used to be over 4,800, is just a little over 3,500. So that's a saving now, a monthly payment saving of over $1,300 a month. So that's a 27% reduction from what it was just a year ago, Gary, which is kind of crazy. And the income required is also a lot less. It's $42,000 less. So you used to need 164,000 to qualify for this mortgage, and now you need only 122,000. So two people earning about 60 grand a year each is quite reasonable and realistic for first-time homebuyers. So again, an improvement of $26,000. So my message is, if you have been somebody who has tried to get qualified for a mortgage, or just didn't even try because you thought there was no chance, and you feel a little sort of disenfranchised or deflated by your previous attempts to get qualified for a mortgage, the good news is now the playing field is now tilted in your favor significantly. So I can tell you just from my own personal experience in the last couple of weeks, mortgage inquiry is up from many first-time homebuyers who we've had in our database, Gary, for maybe 3 years, and they didn't pull the trigger, and now they're finally coming back and saying, okay, we feel good now based on the numbers you see on screen that, okay, we can manage this, we can find property, and we'll go forward this year rather than in the past years.
Yeah, I love it because there's a lot of different opportunities that arise when things like this happen. Now, for those that are looking at this chart, Dion, help us out with, hey, interest rates just dropped today to, the overnight lending rate is different than the interest rate posted here. Provide some clarity on what that is and why that is.
Yeah, so put in simply, the Bank of Canada overnight rate today, it's at 3%. And the rate at which you will borrow from your bank at the retail level is always going to be somewhere between 1 to 1.5% higher than the Bank of Canada rate. So never think that what you see on the news at 3% is the rate at which you can borrow. There's always a markup based on the banks, right? Or based on the bank's profit margins. And of course, they're going to be competitive with their other banks. So they're not going to price themselves another 5% higher. It seems that profitability is still decent at around 1.25%, 1.5% higher than the Bank of Canada rate.
Okay, I got you. Now, where it does tie in and it also provides some clarity on this is for those lines of credit, secure lines of credits, that interest rate will change along with the overnight rate. Yes?
Correct, yeah. So variable rates today are across the board down 25 basis points, 0.25%. So if you have a mortgage, a line of credit, secured or unsecured, then yes, your rates will be directly affected by the Bank of Canada rate. Again, if the Bank of Canada rate's at 3%, I'll tell you right now, it means that, let me just sort of break this down in terms of what we call bank prime rate, okay? So there's the Bank of Canada rate, 3%. The bank prime rate today is now 5.2%, okay? 5.2% bank prime. And then depending on the type of product you are getting from that bank, you might get a rate that is below prime, that's prime minus, or prime plus. So if you're getting a mortgage today and you're lucky enough to get a rate at prime minus 1%, it means that you'd be borrowing money at 4.2, which is 1% below the 5.2. If you have an unsecured line of credit, just based on your good credit history, but not secured on any real estate, then you're probably going to get a rate of maybe prime plus 3, which might be, say, 8.2%. And so, in fact, a lot of people that we help regarding mortgages, Gary, they kind of are confused about lines of credit, and they think lines of credit are at a low interest rate, and they are comparative to credit cards, but personal lines of credit are never as cheap as home equity lines of credit. So at time of renewal, we're often consolidating people's credit cards and personal lines of credit into their mortgage or getting them a home equity line of credit, which is going to save them significantly.
Yeah, there you have it, my friends. And I know there's always some questions or like as you said, maybe somewhat confusion around that. So there you go. So what we're seeing on the chart here is affordability is. I use that, and we'll use that word cautiously.
Carefully, yeah.
Yeah, affordability is becoming more available, we'll say, and it's interesting because Dion and I were looking at a chart earlier around home ownership, and we'll jump into that in just a second here, Dion. But what we're seeing here from this is on the financing side, obviously, that we're looking at. What I'm seeing at from a realtor side and coaching our realtors and so forth and talking to our buyer clients, we are seeing home prices continually month after month, just slightly. We're not talking big percentages, but drop every month. And we're seeing inventory as we knew that we would at the beginning of the year spike. Now, and I use the word spike cautiously as well, but we're seeing more inventory come on the market, or homes that didn't sell last year remain on the market. And then those sellers that thought, I'm going to sell my home in the new year, we're seeing that inventory as well. So depending on where you are, you're probably seeing a number of homes for sale that perhaps you didn't see before, which creates opportunities for buyers, along with the new interest rates that are continuing to come down. So as Dion was just suggesting and saying, perhaps you weren't in that financial position even 6 months ago. Perhaps you are now, because there's two things. Interest rates are coming down, and so are the average home prices. So reach out to, Dion or myself, and we can walk you through that conversation. Okay, let's talk about affordability. Sorry, home ownership. This is pretty interesting because we're seeing news outlets and articles come around all over the place saying home ownership is down. So this is a chart here from Trending Economics. You can go pull up just about any stat you want here in regards to the financial world. And this is Canada home ownership rate. And you can see in 2021, what we're looking at here is just shy of 70% of the population owned a home, which is actually, it's a pretty handsome number if I'm being honest.
I'd be interested to see how that compares with other countries, in particular the USA and the UK, right?
Yeah. Maybe we'll have to do that for our next video, but we can pull that stat with this site here. And then as you can see here, it's gone down. It's gone down to 67. So about 2.5% change in just about 3 or so years. That's going to be the headline. Home ownership is down, 2.5%, or they'll put up a chart like this because that looks significant. Then Dion and I.
I'll just say this, Gary. I think a lot of that translates to first-time home buyers. Many first-time home buyers just simply didn't take the step into property ownership because of affordability or lack of affordability in these last couple of years. So I would say the vast majority of that reduction is first-time home buyer.
Yeah, that's probably a good point. I bet you if we dove down deep and pulled that onion away, that's probably what that 2.5% is. Yeah, for sure. Now, here's the interesting thing. As we zoom out, if we go to the 25-year, you can see that we are, even though we've had 3 years in decline, it's still 67.5 is just slightly below the next best year, I guess you could say, and that back in 2013, 67.8%. So it's always good to get today's data and then zoom out and understand where any data looks like compared to, a larger forecast or research like this, Dion, right?
Yeah. So, I mean, in recent history, we're comparatively worse, but on a 50 or 100-year comparison, we're actually as good as the best previous year prior to the last four years. So
yeah.
That's kind of surprising. Yeah.
And dating back to year 2000, it's always been above that 64%. And like you said, it'd be interesting to see how we compare to some of the other countries, and perhaps we'll have to do that. But just know when you see those headlines come out, and they'll paint the picture. Home ownership is down, and right, it is. But on the bigger picture is, you know what, we're not doing too bad from a nation standpoint like that.
Yeah, yeah, we're looking okay. And I mean, it's interesting, Gary, especially given that Canada's population has grown by about 3 million in the last couple of years. The fact that we're stabilized at that 67% number is pretty good.
Well, I didn't even factor that in. So
Mm.
that's a big piece of it. That's even more to comprehend. But
Yeah.
okay, so I know what everyone's saying. Hey, here's two real estate investors, two homeowners, two people in the industry pumping the market and are pumping the good information. Well, the reality is, my friends, that hey, we know home prices are coming down. Interest rates in alignment with that are coming down as well. There's always opportunity, and it all depends on how you look at it. There's going to be obviously buyers and sellers in every market, sometimes more and sometimes less. It's the information that Dion and I like to provide that helps you make an educated decision depending on where you are. You don't have to be a seller in today's market, but a lot of us, are borrowers in today's market, whether it's investment properties, that type of thing. And that's why it's good to know this info, right, Dion?
Yeah, you bet. And I mean, if anybody out there is curious as to how today's interest rate change affects them, feel free to reach out. I've been able to pleasantly surprise some of our clients who were told one thing, and we could actually get them something better than what they were told. And if you're, especially in the next year or two, there's about 60% of the Canadian mortgage owners are renewing. If you are one of those, just a reminder to never sign that first offer that your bank gives you. It's never going to be their best, and we can almost always get you a better rate if you consider looking at it at a different lender. So remember that you are a free agent at the end of your contract, and we're basically, our job is to act as your agent to get you a better deal.
Well said. Well said. Okay, remind us how to get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Beg.
There you have it. That's the Dion Beg. I'm Gary McGowan. We'll see everybody on the next episode. Goodbye for now.